the dollar will probably weaken. I think that so much gold has been moving east to the Shanghai Exchange and out of Switzerland and out of London and out of New York and probably out of Fort Knox that gradually the real physical price will be controlled in Asia and the paper price will be over here, and at some point they'll diverge.
The world faces peak gold according to Goldman Sachs, but one geologist who's discovered more than 30 million ounces of gold says he knows where to find America's hidden gold deposits. Featured on the History Channel's How the Earth Was Made, this expert gold finder could be on the verge of a massive gold strike. Even a billion-dollar gold giant has engaged this small market cap company to use their proprietary technology. For the thrill of gold discovery with a new edge in Nevada, visit crushthestreet.com/gold.
Hello, everyone, and welcome into crushthestreet.com. I'm Kenneth Amaduri, and I'm joined today with Gary Christenson, who is a writer and owner of a popular contrarian investment site, Deviant Investor, and he's the author of the book Gold Value and Gold Prices 1971 to 2021. He's a man who strongly believes in analysis, objective facts, and rational decisions based on hard data. So I want to talk to him about the economy and specifically precious metals today. So Gary, thanks so much for joining me.
Well, thank you for putting me on the show.
Well, we're glad to have you. You're a first-time guest, and maybe we can just start off with you introducing yourself a little bit, telling people a little bit about your background and who you are.
Okay, well, sure. I'll try to keep that short. I've got a degree in physics. I went on to graduate school in physics and got fed up with that after a while. Passed my PhD exams, but did not write the dissertation. So I'm in that all but dissertation category. Got fed up with doing that and became a taxi driver in downtown Seattle. How's that for a great career decision? And
you're a contrarian thinker. I'm already seeing it.
And I never regretted that decision, although it was not one that most people thought was a wise decision at the time. Anyway, I went on to become an accountant, and gradually I became a business manager for a school district in Alaska and retired out of there. And, I'm an old guy. I'm Social Security age here. And I've just been watching the markets, particularly gold and silver markets, for 30 years or so, and have strong opinions on it. And just to get those out front, I really wish we weren't doing a lot of money printing, and I really wish we were on a gold standard, but clearly that's out of touch and not anywhere close to happening. So we deal with the world as it is.
Gary, let's start off with precious metals here. We got gold holding up over 1,100 now. Silver doesn't want to go below 13. We haven't seen it really do that, and it's holding up in the $14 range. It kind of spiked up today. Is this potentially the start of the gold-silver bull market that a lot of us have been waiting for since 2011?
Well, okay, in my opinion, that's all I can offer here, but I'd like to try to back it up with some analysis. Yes, I do believe it is the start, and I base that on a number of items. The first one is that if you look back over years and years of data, you'll see that in general, and this is my opinion, it's generally supported by the data, gold stocks lead any major trend change in gold and silver. And if you look at the XAU to gold ratio, you'll see that, and I have data on the XAU going back 31 years or 32 years, you'll see that ratio is at an all-time low. The XAU to gold ratio is at an all-time low. And pretty much when that ratio hit a low and then it would rally from there, that also marked gold lows. Again, the gold stocks tend to lead the price of gold. Well, they've just hit that ratio of the XAU to gold ratio, hit an all-time multi-decade low on January 19th. And since then, it's broken out above trend line, and it's like 25% above or 20-some% above that that low. The to me, that's a clear indication that we have a capitulation sort of low in gold stocks, and the same in gold prices. I think gold's actual low price was back in December, but it's been languishing since then, flopping around. Everybody waits for the Federal Reserve and then what the Federal Reserve does do and doesn't do. And I think that given the fact that that ratio is so low, multi-decade low, given the fact that a ratio between the gold price and the S&P is quite low, not a multi-decade low, but certainly a multi-year low, and given that gold has been pounded for almost 5 years, for 4.5 years since its high in August of 2011, that we've had enough time and we've had ratios that show that it's low. It's clearly oversold by any number of measures if you want to use technical analysis. And all of those things point to me as a gold low and a silver low. And you can go on the other side and say, where else are people going to put their money? People are scared right now, I think, as indicated by the price of the S&P and various stock indices going down. I think that the world is going to realize that we need to keep pumping in QE money. And look at Japan. They just went to negative interest rates. We've got over $5 trillion of bonds worldwide that are negative interest rates. Those are not things that indicate a healthy financial system. And so that is, in and of itself, is going to tremendously support the gold and silver market, in my opinion. I better shut up here for a moment and let you...
No. That's, I was sitting here enjoying the content. I was just soaking it all in. I guess what was going through my mind, listen to you talk about the turnaround, is that we've been in such a deep and depressed precious metals market, mining sector market, that people have kind of seen this, where the mining stocks, bounced and moved. And I wonder if we're all conditioned to just assume that that was just a dead cat bounce and going to continue to go lower. Or do you have some thoughts as to why this time might be different than maybe some of the other times that we kind of felt like we were turning around?
Well, I think that and this is just an impression, but I think that we can look at 2015 in general as a transition point or an inflection point in global stock markets. And then we can look at the December, or whatever it was, 19th meeting or something of the FOMC as an inflection point for Fed policy. They cranked up interest rates, or at least they talked about it. And since then, global stock markets have actually come down. And the S&P was like at 2,060 something about on the Federal Reserve board meeting back in December, and now it's around 1900, a little above 1900. I think we've had a transition in mood. I think we've had a realization that things are vulnerable, that the S&P has come down from its May 2015 high, and the dollar is a little iffy. Total national debt's over 19 trillion. I mean, really, is there any way to pay that back? Mm-hmm. And at some point, people are going to realize that the national debt is simply impossible to pay back. Gary, and that means the only way you can continue is to keep it going.
Do you think the Fed, they were trying to get away with that 25 basis point rate hike in December, and, with the stock markets kind of collapsing in their face as an immediate response? Almost. I mean, it was either very coincidental or a direct response to that rate hike. Do you think they're going to have a hard time raising rates in the next decision meeting?
I think they're going to have a very hard time raising rates, and I think they're going to be forced to do things either behind the scenes or overtly to add more QE and to continue to pump money into the system. This is what Chris Martenson had to say, and this was a couple weeks ago. Looking at the next few years, we will experience this as a time of unprecedented financial market turmoil, political upheaval, and social unrest. The losses will be staggering, markets are going to crash, and so on. That's pretty serious. And I think that's just an indication, in his opinion, that the FOMC is going to have to start pumping money again to compensate for global deflationary forces. Either that or the FOMC just admits we screwed up, it's all going down the tube, and we're going to go home and pretend it's not happening. And they're never going to do that. They're going to pump money any way they can to keep the system inflated.
In terms of perception, QE kind of seemed like a success because, they're able to say, hey, unemployment was down, stock markets were up, real estate went up, assets went up, inflation was steady, stable. I mean, going by all their numbers. But raising interest rates, there was like this immediate negative response. So it's almost like they could go back to something that had a positive perception to it to continue to mask this collapsing system. Anyways, let's move on. Do you think it's possible, Gary, that we might see bail-ins here in the U.S.?
I certainly think it's possible. I would love to think it's not probable, but what happens if we have a derivative crash with a couple of global banks that are in $100 trillion worth of derivative problems, and short of the whole system going down, they have to do bail-ins. I mean, it's kind of like 2008 again. We aren't there yet, but I see that coming. And as a consequence of 2008 type of trauma that could occur even in the energy market, or I should say stimulated by the energy market, or just in the bond market, bail-ins could occur. I really hope they don't occur. If they do, there's going to be a lot of anger and a lot of animosity. But they've occurred in Cyprus, they've occurred in Italy, they've occurred in various other European places. They're certainly in black letter law at this point. You do not own your bank account, the bank owns it, and it's a liability of the bank to you. And I don't want to see a bail-in, but that is possible. That's another reason why I think gold and silver have a tailwind behind them.
Do you think the Federal Reserve has the back of the stock market where they won't let it collapse, to where it probably realistically should be valued at?
I think that's a nice delusion. I don't believe that is reality. I think that's what's called the Greenspan put or the Bernanke put or the Yellen put. And look at how well it worked in 2008. I mean, the S&P went from over 1,500 down to 666. That put didn't work very well, and we could all say that the Federal Reserve had the back of the stock market, but they didn't hold it up, and I don't believe they'll be able to hold it up in 2016 either. Yeah. Just my opinion, but that's the way I would think. By the way, if anyone wants to, a far more intelligent opinions, put out by John Hausman, a PhD and money manager, and he essentially, in very fancy language, shares that same opinion.
I tend to agree with you, and I believe that what we are seeing are the effects of all of this, kind of like Mike Maloney puts this stored up energy kind of overwhelming the system, and we're there, and the Federal Reserve is dealing with this at the moment, and their actions, no matter what they do, are not going to be able to stop the overwhelming market force that needs to take place in the global markets. But Gary, if we do see stock markets crash, what's your thought on the dollar? Do you think that the dollar will continue to strengthen throughout 2016, or are we likely, or is it going to deteriorate, with inflation from QE and just a loss of faith from, a failed, broken system?
Well, my opinion is that the dollar will probably weaken, but I have been wrong on the dollar a number of times before, so I have to present that as a caveat. I think that the dollar peaked back in 2015. I think I wrote an article on it showing multi-year cycles and picking that as a high in the dollar. And so far that has been the high. It's certainly possible it can jump up above that, but I think it's going to fall. The dollar fell heavily today, and I think that that's the that's the trend now, that we're in a gradual bear market on the dollar. But who knows? I mean, I don't know. That's just my opinion.
Gary, are we seeing precious metals, the paper price, starting to disconnect from the true value, what the physical price should actually be? And I mean, going back to what happened last week on the LBMA, where there was that discrepancy with it, is this an example of what we are going to continue to see, where the paper price is going to break away from the physical?
In my opinion, yes, and I don't follow it as closely as a number of other people, but I would think that's the case. I think that so much gold has been moving east to the Shanghai Exchange and out of Switzerland and out of London and out of New York and probably out of Fort Knox, that gradually the real physical price will be controlled in Asia and the paper price will be over here, and at some point they'll diverge, and then at some point we'll probably have some sort of collapse and crash in the West in regard to those paper prices. When that occurs, if that occurs, don't know, but it just seems to me like the system is getting more tense and more extended.
So do you have any targets for your precious metals, gold and silver specifically?
Well, I certainly do. They're targets. That's not a prediction. That's not a statement like, I think on such and such a date, I think the price will be. But I think that, we're in the neighborhood of $14, $15 silver right now and a little over $1,100 on gold. And we've the peaks that were occurred back in 2011 were 1923 or thereabouts on gold and nearly $50 on silver. My target on silver is still $100. I don't think we're going to see that in 2016. I don't think we'll see it in 2017, but I think we will see it by 2020 or thereabouts. And I think that that's not even that's assuming that we don't have a hyperinflation. If we have a hyperinflation because things get out of control, then the price, of course, will be far higher than that. Similarly with gold, I'm expecting 3,000 to 5,000 in that period of time, probably on the high end of it. And those are, to me, very plausible numbers, assuming that we don't collapse into a deflationary crash, and assuming that the Federal Reserve responds with money printing to save the system and to save the political and financial elite, which I think they have to do. And I think that you can trust that we will continue to increase our massive debt, and you can trust that as the Federal Reserve buys up that debt and we increase the national debt, that on average prices are going to go up. And as prices go up, you can expect that gold, silver, and crude will go up also.
Mm-hmm. Gary, what do you assume the catalyst will be for the precious metals? What are you thinking will kind of be the trigger? Is it just the mining stocks kind of leading the way and then followed by a gold silver rally? Any thoughts on that?
Well, okay, good question. And my inclination is the mining stocks will be the indicator that show that we're moving up, and I think that indicator has already given its signal. I think that there's just going to be a gradual recognition that the financial system of the world is vulnerable and is a little shaky. And if you had, for instance, $1 billion, would you want that $1 billion invested in bonds from a shaky government issued by a shaky central bank, or would you want to have some of that in a vault, say in Switzerland, in gold and silver? Yeah. And I think that realization is going to strike more and more people, and that will be a major force where people realize that the paper dollars, fiat dollars, and fiat currencies just aren't going to hold their value, whereas gold and silver will.
Do you think Americans experiencing this dollar surge kind of set everyone back on their on that realization that their money should be in precious metals? Because their most recent experience is that the dollar is good, the dollar is strong, and the dollar is safe. So did this kind of kick that can down the road a year, 2, 5 years?
Well, it certainly did. And in my opinion, it certainly did. If you look at the price of gold, or for that matter, silver, in a lot of other currencies, it's either at all-time highs or near all-time highs. And yet, in the United States, with a strong dollar, it's not anywhere near neither of them are near all-time highs. We have been the beneficiaries of the global reserve currency and the beneficiaries of dollar strength, and consequently the price of gold and silver have languished. And if you're from the point of view of a stacker who's simply trying to accumulate more ounces, it's been good. If you're trying to trade them, or if you're worried about what happens over the short term, it's been very traumatic. But gold and silver are long-term investments. People refer to them as insurance policies, and that's, they're stores of value, and they will go up and they will go down. It's the same thing with putting your money in the S&P. It will go up and it will go down. Right now, I think you should be pulling your money out of the S&P and putting it in gold and silver, but you won't find a lot of people agreeing with me.
Gary, I definitely do see the severity of this, and I definitely believe that people do need to be very careful with their investments and have a good portion in that precious metals and protecting their long-term wealth. And it is really an opportunity. I mean, if you just look at where silver was a few years ago, as you pointed out, I mean, it's on fire sale at the moment. You can get the very same thing that you could have a few years ago for dirt cheap prices. Even if it goes down to $9, who knows? It's still really cheap at the moment. So, Gary, is there anything else that you had on your mind that you wanted to share with our audience today before we close the interview?
Well, just one quick comment. You mentioned that I wrote the book, Gold Value and Gold Prices from 1971 to 2021. In that book, I defined a valuation model, not a timing model, but a valuation model for the price of gold based on three macroeconomic variables. And those three macroeconomic variables were the national debt, the S&P 500 index, and the price of crude oil. And as we all know, the price of crude oil has absolutely tanked. And so the valuation model for the price of gold has declined. And by the way, that model, when you smooth it out over with some long-term moving averages, has a very close statistical correlation with the actual price of gold going back to 1971. The point of this is that the evaluation model says that the price of gold should be right now somewhere in the $1,200 to $1,300 range. So as far as I'm concerned, gold is still undervalued by that valuation model. And if you project that valuation model going forward a number of years, back to say 2020, 2021, then you get the much higher prices, unless you presume that the S&P goes sky high, unless you presume that the national debt starts dropping, and unless you presume that crude oil stays as low as it is, all three of which I think are extremely poor assumptions. So that pushes those prices change the model, and that indicates that the model says the prices of gold can easily be double, triple, quadruple current prices.
Wow. I haven't read your book, Gary, but I definitely do want to check it out. I appreciate you coming on the show with me today. If people want to reach out to you and learn more about you, can you let them know a little bit more about your website and what they can find if they visit you there?
Well, certainly. The website is deviantinvestor.com, just like it sounds. And I write a couple articles a week. And primarily I'm focusing on gold and silver with occasional comments on the economy and central banking. You can find my articles there. My articles are also often listed on 321 Gold and GoldSeek and a number of other sites. You can find my books on Amazon, of course. I have Okay, going back to that in case we had a little glitch there, I have 2 books out there on Amazon, The Gold Value and Gold Prices from 1971 to 2021. That's the empirical model of valuation for gold. Then I have a second book out there that's fiction. But it's really a model for the price of silver and a description of the demonetization process for the price of silver back in the 50s and 60s. And that book is Who Killed Dr. Silver Cartwheel? Again, it's fiction, but it's really a discussion of silver and the future price of silver, again, in the 2020-2021 range. Both of those books are available on Amazon, and of course they're available on my website, gechristenson.com.
Everyone, be sure to check out his website and his books. Gary, thanks so much for taking the time to come on the show with me today.
You're certainly welcome. Thank you.